Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. October is National Financial Planning Month. Financial planning, as we know it now, includes investing, tax planning, retirement planning, and basically other ways to get your finances in order and create mindful budgets to ensure a safe and secure future. Getting a step ahead of your spendings and finances is beneficial in the long run, and Financial Planning Month is the perfect time to do that. And Caleb, we talk about budgeting and saving and investing, but crypto is now becoming a bigger part of the conversation. Explain to us exactly what cryptocurrencies are.
Yeah, you have to be planning. If you're investing in crypto, this is a part of your financial plan and your long-term assets. So let's start with the basics. What are cryptocurrencies? These are digital assets, Jill, based on a network that's distributed across a large number of computers. People talk about the blockchain. That's what they're talking about. And the cryptocurrencies, think of them as the cars on the highway of that blockchain. It's the digital ledger, that blockchain, that's that ledger technology that tracks ownership of tokens like Bitcoin, like Ether, even NFTs, and we'll get to those in a minute. But these are decentralized coins, not backed by the dollar, not backed by gold, not really backed by anything. So they're very risky assets, although a lot of people are investing in them.
What's the difference between tokens and coins?
Yeah, that's a great question. Coins are these digital currencies created as rewards for solving computational problems. Bitcoin is one of those coins. You solve problems through connecting computers to come out with an outcome. That outcome usually is Bitcoin in the Bitcoin world, and that is tradable. Tokens are programmable assets within the blockchain for specific platforms. So people talk about Ethereum or Ether. That is what we call a token.
What does it mean that Bitcoin has limited supply?
Yeah, this is what gets people excited about Bitcoin. When Bitcoin was created, and we really don't know who created it, there's a lot of rumors out there, there was only 21.4 odd million Bitcoin that would ever be created, that were ever allowed to be created. That creates a limited supply. So as more and more people and institutions start buying this asset, the supply gets smaller and smaller, and that should theoretically drive up the price. Doesn't always work that way, but that's why we've seen Bitcoin go up about 600,000% in the past 10 years.
And we can see it on the next chart, just looking at the trading history.
Yeah, it's very volatile, but it is one of the best performing assets we've ever seen anywhere in the capital markets, but it is super volatile. You have to have a very strong stomach for Bitcoin, and basically, since it's not backed by gold, not backed by the dollar, not backed by any real assets, you're really hoping that other people are going to want to pay more than you bought that Bitcoin for. So it's a very speculative asset. That said, it's done very, very well.
How do the different generations approach it?
Yeah, younger generations are much more into it. In a recent survey we did nationwide, we found that up to more than 30% of younger folks, Gen Z, were already invested in Bitcoin, and so many of them are counting on Bitcoin and cryptocurrencies to deliver returns that'll enable them to retire early. So they have a lot of hopes bet on cryptocurrencies, but as I said, it's a super volatile space, very volatile asset, and there's only a few of them that are probably going to make it out of this first stage.
How do you trade it, and where can you transact it?
Yeah, you could trade it on your own, on your phone. You can trade it on your computer. There are what we call Bitcoin or cryptocurrency marketplaces that allow you to trade it. Coinbase is one of them, but some of the biggest brokers in the world are now allowing you to transact with Bitcoin or other cryptocurrencies. So it's as easy as trading stocks, except it's very risky.
And let's talk about those risks.
Yeah, the risks are, again, it's not regulated. It's not regulated by the SEC. It's not regulated by FINRA or any of the regulatory bodies that govern the capital markets right now. It's out there kind of like the Wild West, so there's no regulation. There's no backing by any major asset, so you're really hoping that the price continues to rise, and there's no rhyme or reason on why it does necessarily. So it's risky, it moves around a lot, so you should only invest a small amount of your portfolio in it if you're going to invest at all.
Tell us about NFTs.
NFTs, these non-fungible tokens, everybody's talking about these. These also can trade like a stock or even like a cryptocurrency, except they're even more volatile because these are digital representations of artwork in some cases, digital representations of music in some cases. So think of these as collectibles that you could buy that might have value, and that might have value to the next person should you want to sell it, but there is no rhyme or reason as to the value itself. But folks have probably heard about some of these NFTs garnering $55, $75 million at auction. Some of these very unique one-of-ones. They are non-fungible tokens in that they are a one-of-one. There is no other than what they are, and you can see their authenticity through the blockchain. These can trade, as I said, but they're super speculative.
All right, Caleb, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.